I'd have to make a judgment on what you see as revenue for the last year, not based on like what you have globally. So that's what you said, yeah. So you know what the air traffic is globally. That's the essential part of
Okay.
business model, right?
So I was able to find a list of clients, like all the airlines I sell to, but not a nice revenue breakdown by country.
You didn't break it down?
Well, I'm Bombardier. In the U.S. filing or
There are no filing for a company, but it might be a full filing.
okay.
It doesn't really
Yeah, I have the annual report. I guess I better look.
when I valued Bombardier at the start of the year, I definitely thought that.
Okay. Okay. Well, thanks, sir.
So give it a shot. I'm sure it's
there are a lot. I think there are going to be a lot of problems.
they're bigger problems. Your bigger problem's not going to be that. So in fact, an immense amount of debt. And there is ways of
Great.
Okay. It's very little interest. Still trying to day project to present your array of recommendations. The only thing that's going to cut across here is what kind of people. There's going to be a selection bias. Optimistic people gather together to find out a bias, so then I think that kind of bias is going to present recommendations. But other than that, it's very
And then lastly, if we could apply those international
This isn't a definition of it's imported now.
I'm just asking for your opinion on this.
Yeah, absolutely. Especially one of these in luxury retailing or Okay, folks. So, if you've been reading my emails, you probably also know that last class there was a technological breakdown. The last 20 minutes of the class, maybe 25. There's no audio. All you see is the video, right? How come you guys never mentioned that you couldn't hear me for the last 25 minutes? I have no idea what's going on. I'm just talking. So if the mic goes out, I have no idea. I can still hear my voice. I'm saying, this is good. I can hear myself. But if my mic goes out, please let me know, because otherwise I have no way of getting that feedback. So it looks like a low-tech problem. The batteries just died on the mic now, which means I have to remember to carry batteries with me, I guess, now. But no, that's the nature of technology. But if you did follow through on my emails, what I did was I actually reproduced the last 25 minutes in my office, sitting in front of my computer. And I discovered it took only 15 minutes. I must do a lot of extraneous stuff in the classroom. So I put the missing 15 minutes in, like the Watergate tapes, put it in. And I created this kind of melded video. So it won't show up in your media site links, because obviously I can't mess with the actual recordings they have on their server. So if you click through the link that gives you the actual webcast link, I can't fix that. That's unfixable because it's out of my control. But if you click the YouTube link, or you go to iTunes U and click on the link, you should see the first 61 minutes of the last class, or actually the first 56, because they start the recording 5 minutes ahead. And the rest of the class and you will know when that transition happens, because my face pops up on the screen, which can't happen if it is. So, but I think it's pretty seamless in terms of I pick up on the same slide, pretty much on the same spot. So give it a shot. But as I said, if my mic starts not working, just let me know, right? Because that needs to be fixed, otherwise it goes into the webcast. So today we're going to start with something that I think creates more disputes and debate than any other input into valuation. And that's the notion of relative risk. You know what I mean by relative risk? Basically, I'm saying we've got a risk-free rate, we've got an equity risk premium. At this stage, if I asked you what's the cost of equity for an average risk company, you're already there, right? Risk-free rate plus equity risk premium is the cost of equity for an average risk company. And as we saw, if you trust my implied premium calculation right now, the cost of equity for an average risk US company that gets all of its revenues in the US right now is about 7.5%. That's the implied expected return we got by backing it out. So at one level you can say I'm done. I'm going to use 7.5% as my cost of equity for every US company. You're going to run into two problems. One is fixable, which is your US company might get its revenues outside. The other is it could still be a US company with its revenues in the US, but it could be much riskier than the average risk company. So the final piece I want to bring into the cost of equity is how do you measure this relative risk? And of course, if you've taken any finance class or along the way, you've been taught this is easy to do. Run a regression of your stock's returns against a market index, and the slope of the line is the beta. That's how I was taught betas. If you took my corporate finance class, that's not the way you were taught betas, but if you took the foundations class, that's the way betas are taught pretty much everywhere in the world. Horrible way to think about betas, and let's see why. Let's say you have, you're valuing Petrobras, so this is going to be something you have to deal with, right? So you're valuing Petrobras, you need a beta for Petrobras. You go to Bloomberg, mixed blessing to have access to this much stuff at the drop of a hat. You look up the beta for Petrobras. And in fact, you know how to do this, right? You find your company in Bloomberg, you type in the word beta, magically this page appears. I've printed off the betas for Petrobras, but I have two different beta regressions you're going to see here. And this is something that many of you are going to face in your companies, especially if it's a non-US company. The first is actually a regression actually Bloomberg ran for me, of Petrobras' local listing against the Bovespa. And this is actually the default in Bloomberg. When you look up a company and you ask for a beta, the beta you're going to get, the adjusted beta, all that neat stuff, is a beta against the local index. So to the left, you see it. So because it's a local return regression, the currency is in reais. The beta that I get from this regression is 1.66. And this is a statistical estimate, right? It's a beta is a regression. A regression comes from statistics. So I'm going to give you the standard statistical add-ons. The R squared of this regression is 69%. The standard error of the beta is 0.13. Then I went back into Bloomberg and I typed in Petrobras, and this time I found the ADR. You know what the ADR is? It's basically a foreign company that's listed and traded in the US. So all the returns are in dollar terms because you buy it in dollar terms, you return. So the second regression is a regression of the ADR, and the default beta there is actually against the S&P 500 because it's a US listing. Bloomberg defaults to the local index. So second regression is of the ADR. The currency is in US dollars. The beta from this regression is 1.98. The R squared is only 21%, and the standard error is 0.48. You ready? You're doing a valuation of Petrobras. So I'm going to put some words into your valuation, which hopefully you don't take as the indicator. But let's say you're doing a valuation in US dollars. Why? Petrobras is an oil company. It actually reports its financials in US dollars. You're deciding to do a US dollar valuation. You've decided to use a regression beta in your valuation. So I want you to think about which of these two beta, obviously the numbers are very different, right? 1.66 versus 1.98. Which of these two regressions are you going to use for your regression beta? So let me start with you because you're valuing Petrobras. Which one would you use?
Well, I should use the US one, but the problem that they have
No, just give me one. So don't hedge your way. So basically, it's true. There's pluses and minuses. I can see where you're going. You said you should use the US one. Why?
well because we're using US dollars.
Okay. So basically, let's pause right there. The answer he gave me was because you're doing the valuation in US dollars, you should use the US dollar beta, and that's the rule we use for the risk-free rate, right? It doesn't really work with betas, and here's why. What currency is a beta in? It's no currency, right? It's a relative measure of risk. One thing about betas is currency is not an issue. So the fact that you're doing evaluation in US dollars is kind of irrelevant because you want the best estimate of relative risk you can find. And the currency you do the valuation in doesn't matter. Okay. Why? You did the valuation in US dollars. Are only Americans allowed to think in US dollar terms? No. Right. And why are you doing that? Because you're doing your cash flows in US dollars, right? When you do your cash flows in US dollars, it's not just a US investor cash flow. It could be a Brazilian investor thinking in US dollar terms, right? So the fact is the currency you pick for your cash flows is just a measurement device. You can convert like Fahrenheit to Celsius, pounds to kilograms. You've converted reais to dollars. It's not a US investor perspective, and it's in fact a very commonly held misconception that if you do a valuation in US dollar terms, that you're valuing a company for a US investor. That's not true. I could be any investor in any part of the world and think in a different currency if I wanted to. So you're right, I'm doing my cash flows in US dollars, but that shouldn't drive my choice of betas if I think I can get a better beta estimate in one currency as opposed to the other.
Right. My choice is that the markets that I'm using, the premium risk, the other variables, is the US market. That's what drives my choice for the beta.
Okay, let's pause right there.
The beta is the regression from the return of.
So you're saying you trust the S&P 500 more than the Bovespa? So why is the
Well, to calculate the cost of capital, use the premium risk of the market.
Okay, now we're going to something. You're saying you used.
Analysis against the US market index.
So you're saying your equity risk premium came off the US market, but it didn't, right? Because for for Petrobras, you're still using risk premiums from around the world, right? So. No, but you use neither, right? Because what's the equity risk premium we said we should use for Petrobras?
Well, depends on the cash flow, right?
And where they get their revenues, right? Do you see what I'm saying? There are three separate numbers in your cost of equity. There's the risk-free rate, which is a currency choice. There's the equity risk premium. That's neither US nor Brazil. It depends on where you do business. And then there is the beta. There are three separate choices. And actually, I'm saying delink the three choices because your objective is to get the best beta you can, the best estimate of relative risk. And then actually I made your life easier because otherwise people get locked in. They pick the risk-free rate in US dollars, they feel that everything has to come from the US market. And I'm saying you're okay using a different way of estimating betas. So we've now taken the US dollar out of the equation. Now which of these two regressions would you pick? Now you're saying this is easy. It's a statistical choice, right? The R squared is higher against the Bovespa, therefore I'm going to go with the Bovespa. Why is the R squared higher against the Bovespa? Because the Bovespa doesn't have that many stocks in it, and Petrobras is a big part of the Bovespa. Do you see the trap you're going to dig yourself into if you make R squared your defining variable? Because these are not statistical choices anymore. I can get a great looking R squared, and I'll show you a couple of regressions where the R squared is close to 100%, and I wouldn't trust those betas further than I can throw them. Let me add a final layer to this. So the currency doesn't matter, the R squared doesn't matter. What if you, before you even sit down to value Petrobras, have a bias? Bias in which direction? You think Petrobras is overvalued. So even before you do the valuation, you think you're going to find it overvalued. So you want to come up with a low value to justify your priors. Which beta might you pick here because you have a bias? You want to come up with a low value. Do you want to go with the high beta or low beta? Try again. You want a high beta because that pushes up your cost of equity, pushes up your cost of capital, pushes it down value. You're saying that is so unscientific. It is unscientific, but bias, as we pointed out, drives valuations. Today I'm going to dig a deep hole for regression betas, and bury it so far down that you're never going to find it after this class. And you already see, just with this very simplistic example, why I don't trust regression betas. So when an analyst says, I used a regression beta, the questioning just has to start, right? I can't take that as a fact, because I don't know which one you picked, why you picked it, and where this is going into your valuation. So I'm going to offer my alternative, and those of you in my corporate finance class know this alternative pretty well. I said I don't trust a single regression beta, and I'll come back and justify why, but I said I trust an average of dozens of regression betas. You think, if you don't trust one, why would you trust an average? Because the law of large numbers bails me out. So one of the things we're going to talk about today is coming up with a beta for your company by looking at an average beta across other companies like yours. So let's take the Petrobras example, right? It's an oil company. I want to come up with a beta for oil companies. This is a statistical problem, so let's be very clear. This is not a finance problem, it's not an economics problem. And remember, what's backing this approach is the law of large numbers. And I've given you a clue as to what the answer is going to be given that law. So here's my choice. I can pick a small sample of companies that I think are just like Petrobras. In what sense? I might pick just emerging market oil companies and say, look, I don't want to bring in Exxon and Royal Dutch because that's going to muddy up the waters. I want to have companies just like Petrobras. And I'm going to end up with maybe 5 or 6 emerging market oil companies that look just like Petrobras. That's choice one. The second is, I can pick a large sample of oil companies, all integrated oil companies. There are about 70, 80 of them. And that's going to include the Exxon Mobils, the Royal Dutches, the small companies, the big companies, the troubled companies, the high debt companies, the low debt companies. Or maybe, I'll just pick one company. How about Ecopetrol? Another Latin American oil company. I'm saying, you know what? They're both Latin American. We have this nasty habit of putting everything in a region together. They must be like each other. So I'll use Ecopetrol's beta as Petrobras's beta. Let's start by ruling out the one choice we shouldn't make. What should I never use? If I'm running away from one regression beta because it's problematic, picking another company's regression beta is just going to be just as problematic. Different problems, but just as problematic. So that doesn't work. So the question I'm asking you is, would you rather have a small sample of companies that look a lot like yours, or a much larger sample of companies where you're willing to relax the constraints? Because again, this is a question you'll have to face. When you value a company and you try to come up with a beta for your retail company, you could pick small retail companies just like yours in the country you're in, or a much larger sample. Which do you think is a better approach for getting a bottom-up beta? I gave you the clue, right? What's the law? What does the law of large numbers need? Large numbers. It kind of answers the question yourself, right? I'd much rather have a sample of 80 companies with a lot of noise than 5 companies which are just like mine. It's going to make a big difference. In some sectors, you can still be selective and get big samples. There are 650 software companies which are publicly traded just in the US. You want to pick just small software companies, you'll still have 100. That's fine. But if by picking small companies you end up with 4 or 5, you might want to go back to the larger sample. Finally, we talk about comparable companies all the time, right? In pricing, we talk about other companies just like ours, and these are the comparable companies. So, in fact, we've actually shortened this to comps. What are the comps? And if you've done any kind of work in valuation, whether at a bank, consulting firm, you know what the next step in this process is, especially if you're a low person on the totem pole. When somebody says, what's the comps, your stomach drops, because you know what's coming next. You'll be told to go collect the comps. So you ready? Let's go looking. And here are the choices. I can look for other companies in the same industry group. So if I have a software company, I look at other software companies. Okay? I could look at a firm listed in the same market. So these are not mutually exclusive. I could keep adding all of these. So companies in the same sector, companies in the same market. So if I'm looking at a software company in the US, I might start with software companies and then say only US companies Then I say it's a small company, so I'm going to add a market cap constraint. Only small software companies in the US with a market cap less than 100 million. Or maybe this is the wrong path I'm going, because I'm kind of trying to find companies that are just like mine in terms of the products you produce in the sector you belong to. We kind of started on this discussion in corporate finance, but let's go back to this discussion. What's the essence of a comparable firm when you think about estimating beta? Beta, after all, is a measure of systematic risk, right? How much you're exposed to the market. A comparable firm does not have to be a firm in the same business. It has to be a firm that is affected by the same economic forces that you are affected by. Let me give you an example. If I asked you to value a consulting firm, you have two choices. Let's say it's a consulting firm in Texas. There's a reason location is going to matter. You have a consulting firm in Texas, Houston-based consulting firm. First approach is you can look for other publicly traded consulting firms and say, this is a consulting firm, I'm going to give it that beta. Or you can say it's a Houston-based consulting firm. Let's see where they get their revenues. And guess what? If you're a Houston-based consulting firm, where do you get 70% of your revenues? For a lot of energy companies. Or you can say, you know what? It's a consulting firm, but if its mother's milk comes from the energy business, maybe I should be looking at the beta for oil companies. It's a very different way of thinking about comparable firms, but it frees the mind to say, hey, maybe this is not the sector I should be looking at. I should be looking at other companies that get their, basically other companies whose revenues go up when your revenues go up, and their revenues go down when your revenues go down. You're looking for companies that do well when you do well and do badly when you do badly. Makes it a much more messy process, right? Because you can't go into Bloomberg and say, find me all steel companies and be done. Because if you have a very unique steel company that feeds into the automobile business and only into the automobile business, a better estimate of your beta might be to look at automobile companies rather than steel companies. And here's the final piece of the puzzle. So you have a beta, risk-free rate, risk premium, you come up with the cost of equity. Now you get to the other half of the equation, which is the cost of debt. You want to estimate a cost of debt for your company. So this company is a company with only one debt on its books. It's $1 billion in bank loans outstanding. Okay? The interest rate on those loans that was set at the time that you took the loan was 4%. Right? So when you take a bank loan, the rate is set up front. There's a remaining maturity of 8 years. You're going to see why all of this additional information is thrown in here. Okay. The current risk-free rate is 5%. You say, how can that happen? Well, rates go up, rates go down. So you borrowed money when rates were low, and you were able to borrow at 4%. This is good. You've locked in debt at 4%. The risk-free rate right now is 5%. And if you went out to try and borrow money today, you'd have to pay 2% more than the 5%. Why? Because you're a company. You have default risk. You can't borrow at the risk-free rate. So I want a pre-tax cost of debt for your company. So let me throw some numbers out at you, and you tell me whether I can use those numbers. I can go with the 4% saying that's what I borrowed money at, that's what my book interest rate is, that's what I will have to pay for the next 8 years, and use that as your pre-tax cost of debt. It's choice one. The second is you can say that's too low, I'm going to use at least the risk-free rate and use the 5%. The third is you can look at the rate at which you can borrow money today, which is 7%. Or you can do this weird averaging out of taking the 4% you have on your books and the 7% you can borrow money at and go halfway between those two numbers and come up with 5.5%. So what do you think I should do? Does everybody agree on 7%? Because we do, then we can move on. Does anybody want to disagree with it and go with the book interest rate? Half of all costs of capital around the world are computed using book interest rates. I hope you have an argument ready. Because now you're going to be the disruptor, right? Because they've always used book interest rates. So somebody tell me why I should use a hypothetical rate I can borrow at today when I have an actual rate at which I've already borrowed money. You're looking at investing for the future. Give me a very simplistic example of the trouble I'm going to get into if I use 4% as my pre-tax cost of debt.
You're going to underestimate your cost of debt and overestimate your cost of capital.
I'll give you an even better way to kind of bring this home. Let's suppose I'm 95% debt, 5% equity. Let's make this a company which is almost all debt. So the 4% cost of debt, forget the tax benefit because that will make it even worse. You have a 4% pre-tax cost of debt. You say, well, I'm going to put that in. My cost of capital is going to be maybe 4.2, 4.3%. You ready? I come to you with a project that makes 4.5%. Based on your calculation, what would you do? So this is a great project. I should take it. You see how absurd that is? The risk-free rate right now is 5%. You could take that money, put it in a T-bond and make 5%. It'd be crazy of you to invest in something that makes 4.5%. But that's exactly what's going to happen if you leave your cost of debt at that book interest rate. So when book interest rates get used, remember that they reflect. The counter you're going to get is, but we were lucky. We were able to borrow money at 4%. You're right. And I will give you that benefit somewhere else in the valuation. It's not going to be in your cost of capital. That's a good question. The question is, what about private companies where you cannot estimate the default spread? First, is it true for all public companies that I can estimate the default spread? In fact, I must have made it up here, right? Because this company has a bank loan. It probably doesn't have a rating. It doesn't have bonds. Today we'll talk about estimating default spreads for all companies. It doesn't have to be private or public because when you're lending to a borrower, what do you base the default spread on? Their capacity to pay you back, right? This has been true for as long as people have been lending money. Whether you're public or private might make my life simpler, but ultimately when I lend money, I'm assessing your credit risk and charging a spread for that. And I should be able to do that for a private business as well as a public company. It might take a little more work, but that's exactly one of the things we're going to confront is with private businesses. You don't have this out of saying, I'm a private company, therefore I'm going to use the book interest rate, because you still have a problem. We'll also talk about something that is very specific to some companies, whereas what if the government is lending you money at a subsidized rate? Can I use that as my pre-tax cost of debt? We'll confront that question because that's another question that's going to affect what you compute as your cost of capital. One final add-on question. This company has $1 billion in bank loans, right? And I've given you the characteristics of those loans. Let's say it has $1 billion in market value equity. Remember, in cost of capital, the weights you're supposed to use are market value weights. Market value of equity I've given you to be $1 billion. The debt is not traded. You just have a book value. So what do we usually do? We cheat. We use the market value of equity. We wave our hands about the debt and use the book value of debt, and we would attach a 50-50 weight. And most of the time, you're going to get away with it. But let's do this right. If I'm using market value of equity, I should be trying to get a market value for debt as well, right? You see, how the hell am I going to do that if the debt is not traded? Does it have to be traded for me to be able to estimate the market value of this debt? What have I given you? I've given you the book value of the debt, which is $1 billion due in 8 years. I've given you the interest payment on the debt, which is 4% of that $1 billion. And I've also told you what it would cost you to borrow money today, which is 7%. You see, where do I go with that? If you can price a bond, what do you do to price a bond? You take the expected cash flows and you discount them back at today's interest rate. So you take $40 million for the next 8 years, $1 billion at the end of the 8th year, you discount it back at 7% for the 8 years. You don't have to give me an exact answer unless you're a genius. But will the value I get be less than $1 billion or more than $1 billion? It's going to be less than $1 billion because the interest rate is higher than the coupon rate. It's probably going to be $920 million, which means my debt ratio for this company is not quite 50%. It's going to be 46% and 54%. And that's exactly what we're going to do with all companies. Because if we don't do this, we're going to get lazy. If we keep using book values, it's not that different, not a big deal. Until you run into a company where it is different, and you should have done this right from the beginning. So in a sense, we've got the whole class done already with this pre-class test, but it might as well flesh out the specifics. So let me go closed it by mistake. Now I'm going to open it again. So we're on page 79 of your notes. So let's start with that page, because as I said, my first job for today is to dig a hole for regression betas and push the beta into the hole. So let's go to page 79. Okay, so as I said, our mission, at least the first mission, is coming up with a measure of relative risk. So as I said, we're all taught betas the same way. Run a regression of returns in the stock against returns in the market. The slope of the line is the beta. So let's take that regression beta and let's see what can go wrong with it. Okay. First, yep. Actually, I don't control. I tried from outside. There's no temperature control here. I agree with you. It's freezing here. I don't know what they're trying to do to us. If one of you can go upstairs and tell this, I thought somebody did before the class started. Go to the security guard. Somehow the temperature controls are in a secure location, which is undisclosed. Now, that'll be good. I mean, I agree. I mean, it's freezing, and I think for some reason people think you can't fall asleep while you're freezing. That's probably true, but you can't listen either when you're freezing, which is not good. No. So I'm sorry. I'll mention it to the higher powers once I'm done with the class. But there's like a 3-week lag between what happens outside and what they do in these rooms. So the temperature is actually set for 3 weeks ago, but the temperature was like 88 degrees outside. So sometime in November they'll get this winter's coming. You should just look at the calendar. So let's look at the problem to regression betas, and let me use some actual regressions to illustrate this process. First, I ran a regression for GoPro. I mean, I want to value GoPro. In fact, I valued it a couple of times. So I said I need a beta for GoPro. I went and looked up the beta. This is good, right? I have a regression beta of 1.60. I'll talk a little bit about adjusted betas in a second, but the regression beta is 1.60. But before I get too excited, take a look at the standard error of the beta. What does it say? 0.50. My regression beta is 1.60. My standard error is 0.50. If I asked you in the statistics class to give me a range for GoPro's beta with 95% confidence, your beta is going to lie anywhere between, I made the numbers nice and easy, 0.6 and 2.6, right? Fat lot of good that does you. You're saying, what about the adjusted beta? What about the adjusted beta? If you remember, it's 2/3 times the raw beta plus 1/3 times 1 for every company in the face. There's nothing adjusted about the adjusted beta. It's just a raw beta moved towards 1 the same way for every company in the face of the earth. The only thing fancy about it is the word adjusted in its name. Nothing else. So regression betas are almost useless when they're this noisy, right? Because if you're valuing GoPro, you're saying, which beta do I use? You're saying, I'll wait for a better company. Hey, do you like this beta? Every point is on the line. This is like a perfect statistical regression, right? R squared of 94%. Standard error of beta is 0.03. Until you look at what I've regressed. Regressed Nokia against the HEX, the Helsinki exchange. You're saying, why did you do that? I didn't do it. I went to Bloomberg, asked for a beta for Nokia, and guess what Bloomberg gave me as a beta against the Finnish index. Why? Because Bloomberg is incredibly parochial. You ask for the beta for a Finnish company, they're very helpful. They'll give you a regression against the Finnish index. This is exactly what you saw in a milder form with Petrobras against the Bovespa. This is at the minimum, at the maximum, this is what happens when you have a stock which is 80% of the index. That's what Nokia was in early 2000. 80% of the index. No wonder it works so well. You've regressed Nokia against Nokia. And it's completely useless. Why? Because the people investing in Nokia are not just Finnish investors investing in Finnish stocks. The biggest single investor in Nokia in 2000 was Barclays as part of the global index fund. And when they think about the risk in Nokia, they're not measuring it against the HEX, they're measuring it against the MSCI, the S&P 500, some global index perhaps, at which point your beta starts to become noisy again. So don't play this game of sitting at the Bloomberg terminal and playing games with the index till you get a nice looking R-squared. This is not a statistics exercise. It's an exercise in trying to find out the risk in your company. So that's the first nail in the regression coffin. It's useless when it's noisy. It's even more useless when it's not noisy. Not giving you much room there to use regression betas. But let me dig the hole a little deeper. You probably heard about the troubles that Valiant has had for the last 2 years, right? This is a company where it's been one disaster after another disaster after another disaster. Now, if I asked you today if Valiant was a risky company to invest in, most people are familiar with Valiant and all of its travails over the last 2 years. Of course it's risky. So I went to Bloomberg, looked up the beta for Valiant over the same period where the stock price is collapsing, and guess what the regression beta for Valiant is? It's 0.355. So if I trust the regression, it looks like Valiant is a very safe company. This is a great interview question that you can use on others to torture them now that you might be past this process. How do you explain the fact that a company that's been seen one disaster after another for the last 2 years, almost non-stop, how do you explain the fact that the beta is only 0.36? In fact, let's go back. What is beta measure? How you move with the market, right? It's a very specific measure of risk. If you have a disaster stock, what's happening? Day after day after day, you're having your price drop, no matter what the market is doing. It's the volatility, the standard deviation of the stock can be very high because you're having lots of movements. But if it's unrelated to what's happening to the market, guess what? Your beta is going to start moving towards zero. The same thing is going to happen if you have a stock where only good things seem to be happening, goes up and up and up no matter what, its beta is also going to converge on zero. But here's the practical question. You're sitting down to value Valiant today. You don't want to use that 0.355 beta because it reflects a very strange period in Valiant's history where its beta was pushed down because of events that were completely company specific. So that's another problem with betas. It's one slice of history, and that slice might not capture the risk of that company going forward if something fundamental is changing. And it's subject to gameplay. As I told you, you sit down in front of Bloomberg, you can change the index, starting point, ending point, monthly, weekly, quarter. I mean, you can get 100 different beta pages printed off for your company. Technically, each is a regression beta. But which one you use will very much depend on what story you're trying to sell me about the company. So here I have, I think it's Bombardier. Right? So basically I have the S&P, the Canadian regression and the US regression. I get a beta 1.70 in my US regression and 1.20 with my Canadian regression. Which one am I going to use? It depends on what agenda I have. If my agenda to use to convince you that Bombardier is hopelessly overvalued, that you should be selling short, I'm going to move towards a 1.70 because it fits my story better. That's what we talked about. How you decide which beta to use is very much a function of what biases you bring into the game. So betas are noisy and shouldn't be trusted, and they should be trusted even less when they're not noisy. They're affected by the slice of history you look at the company, and they're subject to game playing. I'm amazed we still allow companies to be valued based on a single regression beta. Okay? So at this stage, let's step back. Okay? A lot of people, especially old-time value investors, have absolute contempt for discounted cash flow valuation. So I was in Omaha earlier this year because talking to, as part of that Woodstock that happens every year, Warren Buffett's thing. These are the classic value investors. And I started off by asking a question. There are about 300 portfolio managers in the room who make this expedition year after year after year. So I started with the question, how many of you do discounted cash flow valuation to value your companies? Now, you think this is the audience that would be most likely to do discounted cash flow valuation. Less than half did. Then I asked the second question. Why don't you do discounted cash flow valuation? A third of the people who did not do discounted cash flow valuation said, well, I have to make too many estimates. So, okay. The other 100, which is 1/3 of the total audience, said, I don't use discounted cash flow valuation because I don't believe in betas. And there's actually a fundamental reason why they don't believe in betas, which is if you're an intrinsic value investor, what are you already saying about the market? The market's screwed up, it's very noisy. We have to value companies based on their fundamentals, and beta is a price-based measure of risk. So at one level, philosophically, they were saying, I don't like betas because you're getting a beta from the market price, and the market price is not supposed to be an input into the valuation. Pretty legitimate. The other half latched on to one of those fundamental assumptions we make in the CAPM, which is, or any risk and return model in finance, which is that the marginal investor is diversified, that you should measure only the risk, you cannot diversify away. So the second half said, I don't have a problem with the price-based measure, but I have a problem with this marginal investor being diversified, because if you think about old-time value investing, you're told to have concentrated portfolios. Buy just 5 or 6 companies, don't do this diversification stuff. So because that doesn't fit, I don't use betas because I don't like the assumption that marginal investors are diversified. Both are legitimate arguments, but neither is a good reason not to do discounted cash flow valuation. So in a sense, this is a graph I drew after I got back from the session to kind of deal with these concerns that people have about using betas in valuation. So let's say you run into somebody who says, I don't like betas. Don't let them get away with I don't like betas. Ask them why. If their argument is, I don't like betas because you make this assumption that the marginal investor is diversified, I'm going to give you some alternatives that you can use instead of betas that take care of that problem, where I don't have to assume that marginal investors are diversified. I might look at your standard deviation as a stock and say, look, I'm not going to do a relative standard deviation. I'm essentially going to compute your total risk. So I'll give you some pathways you can follow if the marginal investor is not, if your issue is that the marginal investor is diversified. If the issue that people have is, I don't like using market prices to measure risk, I'll give you another way of computing relative risk that doesn't use market prices, maybe accounting earnings, maybe book value, maybe balance sheet based approaches. What I'm trying to argue for is just because you don't like betas doesn't mean you cannot come up with discount rates that reflect relative risk. It just requires that you be creative about the way you measure risk and bring it into discount rate. Don't throw the baby out with the bathwater. Don't abandon the process of valuing companies just because you don't like betas. It doesn't make sense. So I'm going to present you with the alternatives for those people who don't like betas. And trust me, you'll run into lots of these in your lifetime. If your argument is, I don't like price-based measures, there you go, yeah. Here are some choices. I'm sorry, that you're okay with price-based measures, but you don't like the marginal investor being diversified assumption. Here are your choices. You could compute the standard deviation of your stock. So for GoPro, for instance, I could compute the standard deviation. Let's say it's 50%. The average standard deviation for the US equity market across all stocks is about 20%. You know where I'm going to go next? I'm going to take the 50 divided by 20. I'm going to come up with 2.5. It looks like a beta, but I'm not running regressions. I'm not looking at only the portion of the risk you cannot diversify. That's called a relative standard deviation. For those of you who might be keeping track of this bank risk argument that's kind of bubbled up to the surface again, there's a paper that was recently written by Larry Summers and a student of his at Harvard that argues that banks have actually become more risky. since regulations were created to make them less risky, that it's moving. And the way they measure risk is they look at the standard deviation of banks divided by the they don't run a beta regression. It's a relative standard deviation. So you've abandoned the notion of only the portion of the risk being diversified, non-diversifiable, being rewarded by looking at total risk. The second is you can use proxy models. You know what you do in proxy models? You look across very long time periods. You look at what types of companies earned high returns during that time period, and you call them risky. This is exactly how we've looked at small cap stocks and low price to book companies and tagged them as risky because historically those companies have earned higher returns than other companies. You're still trusting the market to be right over very long time periods, but you're not making any assumptions about investors being diversified in your assumption. The third approach is kind of a melded approach. You start with a CAPM. Why? Because it's there. You take risk-free rate plus beta times risk premium, and then you augment it with all these proxies you've created over time. You add a small cap premium. You add a liquidity premium. Again, a way out of the box of saying marginal investors are diversified. You don't like that assumption. These are price-based alternatives to using a beta-based cost of equity. You don't like prices. You're okay with a marginal investor being diversified. Here are your choices. If you don't like prices, you know the only other alternative you have to measure company performances? It has to be some kind of accounting earnings, right? So you can use accounting earnings volatility over time, how much it varies over time, and say companies with more volatile earnings are riskier than companies with more stable earnings. That sounds pretty intuitive, right? The only glitch here is who measures earnings? Accountants do. And accountants love to smooth things out. No? So in a sense, if you have a smoothing accountant, you're going to have earnings look stable even when they're not. So it's again, all I'm saying is you're jumping out of the frying pan into the fire. Just do it with open eyes and a heat suit or whatever else you have to do. Okay? But those are accounting earnings-based measures of risk. You can use balance sheet-based measures. I've seen value investors argue that debt ratios are your measure of risk. Companies with high debt ratios are risky. Again, you're using a different proxy for risk. I'm okay with that. If that's what you feel comfortable with defining as your measure of risk, go for it. It could be qualitative models. What are those? If you've ever looked at Value Line is one of the oldest investment newsletters in practice. It's been around more than 50 years. They classify companies into 5 risk classes. 1, 2, 3, 4, 5. So very creative. We have no idea what goes into it, but presumably they use some measure of earnings, prices, some mix of stuff, 1 through 5. I'm okay with that too. That is all you can accept as your measure of risk. I'll take what I can get. At least tell me how you differentiate the 1 from the 5. And finally, there is a creative approach that I think a Harvard Business Review article came up with. And generally, you should be mistrustful of anything that comes out of the Harvard Business Review related to valuation, but it's actually pretty creative. What they did was they said, if you tell me your cost of debt as a company, remember that company, the hypothetical company for where I told you the cost of debt was 7%? They argued if the cost of debt is 7%, the cost of equity has to be higher. So far, we're on the same page, right? And what they come up with is measures that measure how much more risky equity is in your company than debt. This particular Harvard Business Review article took stock prices. So basically, it's a price-based approach. They measure the volatility in stock prices. They measure the volatility in corporate bonds issued by the company. They took the ratio of those two and multiplied by the cost of debt. So if your equity was 1.5 times more volatile than your corporate bond issue, you take the 7% times 1.5, and that would become your cost of equity. You know what? I'll take that too. All I'm saying is, let's not make this the final battle, whether you buy into betas or not. I continue to use betas, but I'm a pragmatist. If you have a different way of thinking about relative risk and you can bring it into your cost of equity, I think you should. Then let's both move on to where the numbers really matter, which is the cash flows, the revenue growth, the margins, and let's talk about those numbers. Let's not make this a debate about the CAPM, the arbitrage pricing model, the multi-factor model, or the basis of all of finance, which is what it ends up being if you let it go there. Any questions? So let me go back to my pathway of estimating risk, and let me talk about why I continue with betas. To me, the reason I stick with betas is I don't think about betas as coming out of regressions. I think of them as coming from basic choices you make as a company. Fundamentally, there are 3 decisions, and only 3 decisions you make as a company that determine your beta. The first is, what kind of business are you in? What kind of products and services do you deliver? And I've used this before in corporate finance, but the more discretionary your products and services are to your customers, the higher your beta will be as a company. You know what I mean by discretionary, right? If your customers can live without your product, they can delay buying it, they can defer buying it, you will have a higher beta than if they cannot do that. So if you look within the retailing space, a discount retailer should have a lower beta than a department store. A department store should have a lower beta than a luxury retailer. Why? Because of the discretionary products and services. So the first choice you make as a company already sets you on a pathway to what kind of beta I'd expect you to have. So if you're Snapchat, the fact that your revenues are going to come from advertising tell me already a little bit about the risk you're going to face, because advertising historically has been a discretionary expense for companies. High when times are good, low when times are bad. I would expect that to show up in your beta. So that's the first choice. The second is, tell me something about your cost structure. The greater the proportion of your costs that are fixed costs, the higher your beta will be as a company. Why? Because if you have a lot of fixed costs, in good times you make lots of money, in bad times you lose lots of money, everything becomes more volatile. So cost structure matters. Third, tell me how much you borrowed. Other things remaining equal, the more you borrow, the higher the beta will be for your stock, for a very simple reason. When you borrow money, you create a fixed cost you did not have until you borrowed the money, right? Which is interest expenses. So your equity earnings will be much higher in good times, much lower in bad times. You essentially created more volatility. You can take a safe company and end up with risky equity if you borrow enough money. And with debt, I can actually be a little more specific. You tell me how much you borrow in terms of a debt to equity ratio. I can tell you exactly how much your beta should be changed as a result of that debt choice. So what business are you in? How much fixed cost do you have? How much have you borrowed? Fundamentally, if you answer those 3 questions, I should at least be able to give you a sense of whether your beta will be above 1, around 1, or below 1. And it's amazing how well that very intuitive approach works in terms of coming up with betas for companies. So I'm going to take you through the process by which I would estimate betas, because I don't trust regression betas. It's a 3-step process. I start off by getting a beta for your business, whatever business I think you're in. If I can, I try to adjust that beta for differences between your fixed cost structure and everybody else's. Maybe you have less fixed costs. You say, why, if you can? You're going to see why that part off, and you throw up your hand and say, I can't do it, and stick with the beta for the sector you're in. And in the 3rd step, I bring in how much you borrow. So let's go through those 3 steps, and let's think about why in that 2nd step with operating leverage, fixed cost, you run into so much trouble. If you gave me a sector with 35 companies, and you gave me the betas for every company, and you also told me the fixed cost and variable cost at every company, adjusting for differences in fixed cost is trivial to do. It's easy to do. And here's why. Remember how we lever and unlever betas? We use a debt to equity. Debt captures the fixed portion of the claims. Equity is the residual portion of the claims. You can actually use exactly that same equation to adjust your beta as a company for your higher fixed costs or lower fixed costs. But I need to know what your fixed costs and variable costs are. Now do you see why I said if you can? Pick any sector you want. And I'll throw this out as a challenge. Find for me how much of the costs in this sector are fixed and variable for each company. So you go to Capital IQ and you say, download fixed costs for me. Doesn't know what fixed costs are. You can say, do you want cost of goods sold? Do you want SG&A? You can make assumptions about which are fixed and which are variable, but accountants don't break costs into fixed and variable. The problem here is an information problem. The reason we don't adjust for fixed cost differences is not because we don't know how to do it or we cannot do it. It's because we don't have the raw data on fixed and variable costs to be able to do it. So most of the time when you use a steel sector beta for a steel company, not only are you telling me what business the company is in, you're also implicitly telling me that this company's fixed cost structure is very much like every other steel company. And the steel sector, you're probably going to be okay. It's very difficult to be a steel company with a very different cost structure than everybody else. But let's take the airline business. I've used this example before. Typically, airline companies have very high fixed costs. So I give you United Continental to value. Use the beta for airlines. I would say that's okay. You're assuming high fixed costs. That's what they have. They're like any other airline. I give you JetBlue or Southwest Air to value. Do you see the challenge you're going to face? Historically, one of Southwest's strengths has been that their fixed costs are lower than the typical airline because of the way they run their businesses. They fly into no-name airports. They use the same kind of aircraft. So in a sense, they've made decisions that keep their fixed costs low. Attaching the beta for airlines to Southwest is in a sense a little unfair, giving them too high a beta, because I'm not capturing one of the benefits of their business strategy, which is lower fixed costs. There I might try to do something to try to adjust for the fixed costs, but even there I am going to be stymied by the lack of information on fixed and variable costs for individual companies. So when you try to estimate the beta for your company, I will understand if you use the beta for the sector, but at least pause and think about, is there a reason for me to believe that my company is very different from the rest of the sector? And if so, how do I adjust for that in my beta calculation? Any questions on fixed and variable costs? Okay. It's in fact, when companies talk about trying to go for a more flexible cost structure, this is the payoff, right? Because when you have a more flexible cost structure, what are you doing? You're moving your cost from fixed to variable. You might have the same total cost, but your beta should decrease if you succeed in having a more flexible cost structure. And adjusting for financial distress. I'll give you the, go ahead.
Do we reward the company within the capital already for having a...
Not really, right? Because you can have two companies. The margins might not be that different with the other. In fact, your margins might be lower with the flexible cost structure. I'll give you an example. Let's suppose you're negotiating with the union. You're a manufacturing company. And the union offers you two choices. Pay us lower wages, but guarantee us the wages. But since you're doing well, pay us higher wages, and we're willing to accept wages that move with revenues. You might actually end up with higher costs with the second approach because you've accepted the higher wages, but by allowing your wages to move over time, you've got more flexible structure. It'd be nice if we can get both lower costs and more flexible cost structures, but all too often it's a choice. Okay? So that's why you can't let the cash flow carry the burden, because the cash flows just reflect your margins. They don't tell you the stability of the margin. They're not factored in there. The number has to show up in your discount rate somewhere. Okay? Any other questions on fixed and variable costs? This, I think, is the struggle around the world as companies start to globally compete, is if you're from a part of the world where the fixed cost structure is imposed on you, and you're competing with the part of the world where the fixed cost structure, you know what I mean by imposed? If you have regulatory requirements on fixed costs in one part of the world that you don't have in another, it's like competing with one hand tied behind your back. It's going to be very difficult for you to compete, because the other company is going to have a more flexible cost structure, lower cost of equity, the same global marketplace. Okay. Now, to adjust for debt, let's start with the old-fashioned way. This is called the Hamada beta adjustment, and it goes back to the early 1970s. And in this adjustment, we make a very strong assumption. We assume that the beta of debt is zero. We don't assume debt is riskless. We assume the beta of debt is zero. You're saying, isn't that the same thing? Not really. Remember, beta measures how you move with the market. We're assuming that debt is risky, but that risk has nothing to do with the market. It's got more to do with your credit risk over time. If you're willing to make the assumption that the beta of debt is zero, the question mark, replace all the question marks with betas. On my Mac, it showed up as bicycles. I think Microsoft, no, don't ask me why. Something happened in the new version of Microsoft. My betas become bicycles on my Mac. They become question marks on the Mac. So, but those are all betas, all the question marks. The beta of your equity will be the beta of your business, the unlevered beta, times 1 plus 1 minus the tax rate. And I'll talk about why there's a 1 minus tax rate in there, times your debt to equity ratio. In other words, I'm loading up all my risk in my company on my equity investors. You're saying, what's the 1 minus t doing in there? It's true debt creates a fixed cost, right? That's not debatable. But what's the 1 plus you get with the fixed cost on debt that you don't get with equity? The fixed cost on debt is interest expense, and interest expense in much of the world is tax deductible. The 1 minus t is in there to capture the fact that the government puts its hand over your shoulder saying, you have a fixed cost, but we'll bear some of that cost with you by giving you a tax benefit. So that's called the Hamada beta. We're loading all of the risk in a company onto the equity investor and saying your beta should reflect that. That's a strong assumption though, right? The beta of debt is 0. You can get away with that for investment grade companies. But let's say you're valuing a company with a CCC rating. Do you think your debt takes on some equity risk? If you're investing in a highly levered company with a CCC rating, your debt starts to behave a lot like equity. Have you noticed that when your company does? So it's got very little to do with credit risk. It's got more to do with what your earnings look like. So you could actually argue that this equation is going to break down when you go to higher risk companies, higher risk at least in terms of default risk. And that's true. There is actually a fix for it, but it'll require some pain. If you feel strongly that the beta of debt is not 0, then I'm going to say, okay, I'm willing to go along with it. What do you think the beta of debt is? Hey, you asked for it, right? You should have just let me keep it at 0. Then if you can tell me the beta of debt, there's actually a version of the levered beta equation that then says, this is how much debt the debt holders will carry. This is what's left for you. Your levered beta of equity will be a function not just of the unlevered beta of the business, but how much of that risk you can shunt off to lenders as part of the cost of debt. What it will effectively mean is your levered beta at very high debt ratios for your company will be lower than the ones you computed with the standard approach, where so if you remember the capital structure section of corporate finance, we estimated the beta for your company at 60, 70, 80, 90% debt and went up to 6, 7, 8, 9. If this approach, the second approach, you're going to see the betas for equity at very high debt ratios be lower than you estimated because some of that risk is being borne by lenders. Do you know how often I use this adjusted version of the beta formula? I don't think I've used it in 20 years. I just show it up in the slides and I move on. It's just not worth the trouble because here's what happens. By doing this, what's going to happen? My cost of equity is going to decrease a little bit at high debt ratios. My cost of debt is going to get bumped up a little bit. And my weighted average cost of capital actually doesn't change that much. So if you feel strongly about it, go ahead and do it. But remember, you have to estimate a beta for debt to make it work. It doesn't make that much difference in the final valuation you attach to the company. So here's the process by which I get betas. I start by finding the business of businesses that your company is in. That should be easy enough to do, right? Look at the 10K, look at the annual report. Then I try to find publicly traded companies in each of these business or businesses. I have 41,899 publicly traded companies in my sample. It shouldn't be difficult for me to find companies in each of the businesses you're in. Those are publicly traded, so I can get betas for all of them. I average the betas. Simple average, no game playing. I take out the effect of debt. Why? Because my company's policy on debt can be very different from theirs, so I unlever the beta, which basically means I want to compute the beta for the businesses that these companies are in. I end up with an unlevered beta for the 5 businesses your company's in. Then I come back to you and say, tell me how much value you got from each business. You might give me revenues or earnings because you don't have value. I'll convert that into a value and come up with weights for your 5 businesses. I take a weighted average of the unlevered betas of the 5 businesses. Then I ask you, how much debt do you have? How much equity? I use your debt to equity ratio to lever that beta up, and I end up with a levered beta for your company, which I'm going to use as my replacement for your regression beta. Again, remember, the savings are coming from the law of large numbers. You're still using regression betas, but you're saying an average of 20 or 50 or 100 regression betas is more precise than any individual regression beta and less affected by slices of history, right? So if I take Valiant and I break them down into pharmaceuticals and biotechnology, and I get the betas from those businesses, The fact that Valiant had 2 strange years doesn't affect my beta calculation because I'm using those averages. So my argument for bottom-up betas is a statistical one. It's far better than a regression beta because it's far more precise. It's far more precise because I'm averaging across 100 slices of history, not one. And there are some added bonuses. If you entered one of these 5 businesses yesterday, I have a chance of showing that in my bottom-up beta because I picked the weights. If you exited a business day before yesterday, I can reflect that you're out of that business. I can't do that with a regression beta. I'm kind of trapped with the company you used to be rather than the company you are today. And later in this class, we'll talk about valuing private businesses or divisions of companies. You see, the bonus this is going to be able to estimate the beta for a company without a regression means I'm freed of that constraint. I can estimate the beta for private businesses, divisions of companies, even an asset standing alone, because all I need to know is what business you're in. So that's my argument, so let me try this out. So first I'm going to estimate a beta for a company you saw in corporate finance, Vale. Right? In fact, this might be the same table you saw. Some of you probably remember all the numbers in the table still. I don't, so let me go through them. There are 4 businesses that Vale was in 2013. I'm not making these up. This is how Vale broke themselves down. Metals and mining, iron ore, fertilizers, and logistics. I've estimated the betas for each business by using global companies in each of these sectors, metals and mining, iron ore, logistics, and fertilizers. So there are the unlevered betas for the businesses. I've given you the sample size. That's the law of large numbers that's working for me. My sample size is huge for fertilizers. And it's still big for my other 3. There's my unlevered beta for the 4 businesses. I'm almost there. Here's the final step. I got the revenues that Vale got from each of these 4 businesses from their 10K. Now, if I'm in a hurry, I could use revenue weights. But when I do that, I'm acting like $1 in revenue in one business is exactly the same value as $1 in revenue in another business, and that might or might not be true because of differences in margins and growth. So I pull up one other number from my comparable companies that I can use to estimate value. It's called an enterprise value to sales ratio. Basically, for each company, I compute the enterprise value, which is market value of equity plus debt minus cash. I divide by revenues. That 1.97 tells me that a typical metals and mining company trades at 1.97 times revenues. So I multiply Vale's revenues from metals and mining by 1.97. I get an estimated value for Vale's metals and mining. And I do this for each of the 4 businesses. Those values are what I use to get my weights. And at least based on my estimates, Vale is about 76% iron ore, about 17% metals and mining, about 5% fertilizers, and about 1.76% logistics. And obviously the weights have to add up to 100%. I take a weighted average. There's my weighted across the 4 betas by these weights. I get an unlevered beta for Vale of 0.844. I have a debt to equity ratio for Vale of about, in this case, about 55%. I apply that debt to equity ratio across all their businesses. I end up with a levered beta. So with that 0.844, for instance, for Vale, the levered beta I then end up with for Vale is 1.15. And that's the beta I would use to come up with the cost of equity for Vale. And that's the beta I would use whether I did the valuation in US dollars, Brazilian reais, Mexican pesos, or Russian rubles. It doesn't really matter because beta is a measure of relative risk. So the case of Petrobras, I look at the ADR beta, I'm going to look at, but then I'm going to go back and say, let me break down Petrobras maybe into exploration. So if I wanted to break it down by business and get a beta for each business looking at publicly traded companies and then take that weighted average, that beta I think is going to be a lot more reliable. Now, but part of you is saying, but it's a Brazilian company. I know. You get a chance to punish it, not in the beta, but in the equity risk premium. Each number in your cost of equity carries its own weight. Don't make it carry a double weight. Betas were never meant to carry country risk burdens on their shoulder. Asking them to do so is unfair. And you're often going to end up double counting and triple counting risk if you do. Any questions? Yes.
So in this example, you're assuming the leverage applies equally to all the data.
That's a good. In fact, if this were a corporate finance exercise at Vale, this has more consequences, right? Because these costs of equity then become costs of capital that are going to be used internally in Vale for investment decisions. Then it might be worth exploring how much of the debt is where. I'm not going to spend too much time in Vale because their 4 businesses are all capital intensive. In corporate finance, the other company we did was, come on, you remember, Disney. Disney, I actually tried to break the debt down into how much debt is carried by theme parks and how much by movies, because those are very different businesses. So depending on the company, sometimes it's worth that trouble of trying to break debt down, but you're not going to find it in their annual report. They don't break debt down by division. It's going to be a choice you have to make depending on the company. Yes? I use the median debt to equity ratio across. I'm a lazy person naturally, right? So when I have that many companies, I say thank you God for a law of large numbers, and I let the law of large. It sounds incredibly casual, but you could unlever each company and then take an average. I've discovered you actually get a better estimate being lazy by taking the median beta, the median debt to equity, and carrying it all through, than trying to adopt more elaborate measures, right? So when you have a large sample, that's one of the advantages you get, is I stop worrying about estimation choices and averaging choices because it doesn't seem to matter very much. Yes?
Since the equity risk premium is multiplied by the beta,
Yeah.
and you're putting country risk into the equity risk premium, why wouldn't you, it's then getting also inflated by that beta or deflated, but why wouldn't you pull it out, add it to the risk-free rate, and then multiply beta just by...
Remember, there are 3 choices with the country risk premium, right? One is you can do what you just suggested, make it a constant, in which case you're saying that my beta risk has nothing to do with country risk, it's a constant. The second is to go the extra step and estimate a lambda, which is a different measure of country risk exposure separate from beta. So that's fine if you feel that your country risk has a very different risk exposure characteristic than the rest of your risk. There's no harm. So if you did that in your cost of equity, I'm perfectly okay with that. It's not going to affect your cost of equity dramatically unless you have a beta of 2.5 or 0.3, but that's fine. That's completely defensible if you do it. Any other questions? Now, the other company I estimated a bottom-up beta for was Embraer. Again, you can see already why I need to go global, because if I stayed with Brazilian aerospace companies, my sample is 1, and it's called Embraer. If I go Latin American aerospace companies, my sample is still 1, it's called Embraer. So in a sense, it doesn't make sense both from a statistical standpoint, it also doesn't make sense just from a business standpoint. I don't know whether many of you have taken flights in the US. If you take a short haul flight in the US, let's say I have to fly to Buffalo. Why I agreed to do this, I have no idea. It's in a week and a half, right? And I wager that I'm going to be on an Embraer jet. Why? Because that's their bread and butter, short haul flights, smaller jets. So they sell their aircraft to exactly the same companies that Bombardier does, and the small Boeings might go after. So to treat them as a Brazilian company for beta risk makes no sense. So I went global. The beta that I ended up with based on the aerospace business was 0.95. That's the unlevered beta for global aerospace. I did use Embraer's debt to equity ratio to lever the beta and the Brazilian tax rate because those are company specific choices. I ended up with a levered beta of 1.07. So it's a much simpler calculation than the Vale beta because I have one business, I get the beta, I'm done, right? So, but let's pause here. Let me play devil's advocate because you're going to get confronted with this question when you use this on a company. Which is, I have a Brazilian company, I'm using a global average. Is it okay to use a global average beta if you have an Asian retailer or a Japanese retailer or a Latin American retailer? Tell me when this is going to get me into trouble. That's really the question I'm asking of using these global averages. Yes? But dig a little deeper. Go back to those 3 things that I said drive betas, right? What are they? How discretionary is your product or service? What fixed cost do you have? how much debt you have. The debt you can take out of the picture because we correct for it. Let's go back to the first. Can you think of a business which is discretionary in one part of the world but non-discretionary in other parts of the world? I can think of quite a few. Take telecom, right? In the US and Europe, if you think about telecom, it's almost a non-discretionary, right? Pretty much everybody has a phone, so in a sense you might get a few and a little icing on the cake, but this is the fundamental business is a pretty stable business because it's a non-discretionary product. Now you go to Asia. Telecom is actually a discretionary product. Everybody might have a phone, but that additional service that you need, people will buy if things are going well, but they will not. So you could actually argue that if I'm trying to value Reliance Telecom, that using the global telecom beta might not be right because I will understate the risk of Reliance Telecom, which is it's a big Indian telecom company, that I should be looking at only emerging market telecom companies. Part of the reason I report averages for global companies, emerging market companies, US, Europe, is to give you that choice if you feel it's appropriate for your company. So I use global for aerospace, and I think it's completely defensible for aerospace. But if this were a telecom company, perhaps I should rethink that and say, what should I be using instead? One other issue, much of Latin America and Europe, when people talk about debt ratios, the debt ratio they're talking about is a net debt ratio. What's a net debt ratio? In a gross debt ratio, you take total debt, you divide by equity, you get a debt to equity ratio, right? That's the debt ratio I tend to use in my class. In a net debt ratio, you net out cash from debt and then divide by the value of equity. See, how much difference can it make? Let's take Embraer. The gross debt ratio was 19%. That's what you saw on the previous page. And the levered beta that I got was 1.07. If I'd used the net debt ratio for Embraer at the time that I did this valuation, their cash balance actually exceeded their debt. So their net debt ratio was minus, and this freaks people out. When they get a negative debt ratio, saying, what the hell do I do now? It's okay. You can have negative net debt to equity ratios, and you can continue to use them. And in fact, if I use that negative net debt to equity ratio, my levered beta for Embraer is actually lower than my unlevered beta. You're saying, this is awful. I'm going to end up with a lower cost of equity. It's okay. If you carry this cost of equity through to your cost of capital and you stay consistent using net debt ratios, you're going to be okay. And here's why. With a beta 0.93, I'm going to end up with a lower cost of equity. Uncontested, that's true. That cost of equity goes into cost of capital, right? Where I take the cost of equity, multiply by the weight of equity, then I take the cost of debt and multiply by the weight of debt. So for Embraer, if I decide to go net debt ratios all the way through, what's the weight going to be on my equity? More than 100%, right? It's okay. It'll work. So you'll have 103% equity times your cost of equity. Then you'll get to the cost of debt and you'll put a minus 3% weight. And unlike a traditional cost of capital where debt actually pulls down your cost of capital, which is what's going to happen with the gross debt ratio, with the net debt ratio, you're going to see your cost of capital go up relative to the cost of equity. And when you're all done, your cost of capital is going to be very close to mine as long as you didn't do crazy things along the way. Like what? Like use 0% debt ratios because the net debt ratio became negative and you were uncomfortable. If you're going to go the net debt ratio route, go the entire distance. Use it in your levered beta, use it as your debt ratio, your cost of capital. Your end cost of capital is not going to be very different from mine. So let's recap everything into the cost of equity. Your choice of risk-free rate will come from what currency you decide to do the valuation in. Not what country, So your beta carries the weight of what business you're in, or businesses you're in. Your equity risk premium reflects where you do business. Everything has its place in there. And you've got to bring it all into the cost of equity. I know it's almost the end, but let me at least set up the cost of debt. We start out with the base presumption here. The cost of debt is the rate at which you can borrow money long term today. Not the rate at which you borrowed money 2 years ago, 5 years ago. It's the rate at which you can borrow money long term today. You already can see two counter questions, right? What if I borrowed money in the past? Remember what we said, doesn't matter. What if I decide to borrow short term instead? That's your choice to make. But when I compute your value, I'm going to act like the rolled over cost of your short term debt is going to be equal to the long term cost of debt. So it's the cost of borrowing money long term today. You know when it's easiest to get the cost of debt for a company? When can you observe a market cost of debt today? So you have bonds traded, and you have a yield to maturity in the bond. You're saying, I'm done, that's my cost of debt. Be very careful though, and here's why. Can a risky company issue a safe bond? Absolutely. You know how? You carve out your safest assets, you issue bonds against those assets. Do you see where I'm going? If you go look up the yield to maturity on a corporate bond and use that as your cost of debt for the entire company, you could be understating the cost of debt if that bond is on a slice of the company that is very safe. But here's the way out. If you have bonds outstanding, usually, what else can you find for the company? You're going to be able to find a bond rating. And that's going to kind of give you a pathway to get a cost of debt. Because if you can tell me what your rating is as a company, you say it's BBB, I can pretty much guess what cost of debt goes with the BBB rating, right? In fact, there are other BBB rated bonds out there trading with a spread of 2.5%. I'm going to say your cost of debt is 2.5% above the risk-free rate. I'm going to make that your pre-tax cost of debt. So for companies that have bonds outstanding, getting the cost of debt is going to be very easy. If you have a bond rating, you're almost home free. But that covers about 10% of publicly traded companies in the world. You're saying, what about the other 90% where I cannot get a bond and I cannot get a rating? When we start our next class, those are the companies we're going to start with. We're going to talk about how to estimate a rating for those companies that we can convert into a cost of debt. And that's going to give us a way out, not just for those companies, but open it up for private businesses as well. Okay, see you.
Very basic corporate finance question. When I'm doing the debt to capital ratio, I'm adding in the market value of equity, obviously, because I've got negative equity on the balance sheet. Sorry?
Book equity never enters.
Okay.
It's always not.
Very good. And I'm using BBD.B. Should I be adding in any other? Okay. Okay, I think I got it. Thanks very much.
I know it.
Why in this calculation
You don't have a 1 minus 3?
No. I was gonna say, why is there no way to reward a company whose ratio is so good that you think that they are actually less risky than the industry? Right? Because this is 1+, right? Even if your ratio of fixed to variable cost is so great that it goes to
beta
zero.
will be an unlevered beta for the business with no cost structure at all. So it's not going to be the beta for the sector. And the steel sector will be like 0.35. And the way that 0.35 adjusts for different steel companies will depend on your cost structure.
Right.
So the average beta for the steel sector is 0.60. That's not what you're going to see as your unlevered. So this is unlevered beta for the business, not the unlevered beta for the sector. It'd be that cleaned up for the average fixed cost structure for the entire business, right? So the companies that have lower fixed cost ratios than the typical companies in the sector will end up with lower betas than 0.60. The companies with higher fixed cost structure. So I am rewarding the companies, right? It won't show up in the 0.30. 0.30 is pure business risk. You're in the steel business. There's already a risk coming from the fact that macroeconomic movements affect you.
Right.
Now I look across steel companies and I separate you based on your fixed cost to total cost. So there will be the reward will show up in that final unlevered beta that I give you for being in this business. It will reflect your lower fixed cost.
I have two questions. The first one is about when we use the large sample of the industry actually analyze the average of the industry data. When we apply it to our own company, we use it as an unlevered data, right?
No, only if you're unlevered. It doesn't magically happen. When you come up with the beta for your industry, you have to unlever.
Okay.
And then once you're unlevered, of course, you use your unlevered beta for your company.
And the second question, do we have access to, do you have the website for corporate finance course?
Yeah, so, just go to use my website, click on classes, you should see it. The whole class is still there.
Okay, your corporate finance course, we can have access to the
Oh
website.
yeah, it's the same way. It's open. It's an open website. So you can click on the web class, click the whole class.
Where can I find that link? The website?
Just use the link that you used for this class.
Yeah.
Work backwards, right? So when you go in, you could be able to click into the main website and click on classes.
Okay.
Right? And you
Okay.
should be able to find it.
Thank you.
Okay? Or you can find it on iTunes U as well.
Okay. Okay.
So I had this question. In beta calculation, sometimes we, for the debt part, we use this tax shield concept. Do you think we should go that route or no?
What do you mean beta? They are levered beta
Yeah.
calculations? You have to, right? Because you're going to use the tax part for the cost of capital. You can't selectively decide that you get a tax benefit of debt when you do cost of capital or not. It's the same idea that's driving both adjustments.
Okay. So we don't just do it for at the cost of capital level, but do we do it at the beta level as well? Like when we're leveling and leveling
It's
beta?
the same interest tax benefit you're talking about. How can you have an interest tax benefit at the cost of capital level and not have it at the level base?
So if we do it, we have to do it in both places.
Probably have a question about this one. How I can get the full calculation. Actually, I try to look at the spreadsheet and then
That's just the average year over the last 10 years, right?
yeah. What does this mean? Actually, it is a return. This is a return.
It's a cash return.
It's a cash return, right?
Right.
So
It's a percentage of the value of the index.
the-
So I'm just taking the 4.22% of the index today and saying if this were a normal year, this is what the cash that would be returned last year.
so we represent the index like, okay, we invest the money like equal to the index today, and then we will get the return like that. Okay.
Yeah.
And then why?